Hello everyone. Today we're talking about why it's a great time to buy Bitcoin and crypto. The current environment is presenting one of the strongest accumulation windows we've seen in years, based on institutional flows, supply dynamics, and on-chain analytics and macro trends. If you want a more in-depth deep dive into any subjects, feel free to comment or message us directly at joshlozierinvestments.com. First, we're going to go over the real reason this is an accumulation window. To understand why this is a favorable moment for long-term investors, you need to look beyond price charts. You need to analyze the structure and forces shaping the market. First, Bitcoin supply issuance has dropped significantly post-halving. Reducing the number of new coin miners can bring into circulation. That creates natural upward pressure when demand returns. Second, long-term holders now control one of the highest percentages of circulating supply in history. When these wallets refuse to sell into volatility, short-term traders can create sustained downward pressure. Third, institutional participation continues to expand. Whether it's ETF inflows, multi-billion-dollar treasury allocations, or custody infrastructure improvements, large capital pools are steadily positioning themselves. Individually, each of these indicators is positive. Together, they create a strong fundamental backdrop that long-term investors should not ignore. Now let's talk about market sentiment versus market reality. Now, sentiment often lags reality. When headlines are quiet, the smart money acts. Historically, the most profitable accumulation periods occur when volatility compresses, retail attention drops, on-chain accumulation increases, and exchange balances decline. We are witnessing these conditions right now. What does that mean for you? It means you may be standing in the middle of an opportunity that does not feel obvious. Markets rarely reward comfort. They reward conviction. Let's go over on-chain indicators every investor should watch. First, there is exchange outflows. When Bitcoin and major altcoins leave exchanges and move into cold storage, it signals long-term holder confidence. Consistent outflows reduce liquid supply. Second, realized price bands. These levels show what price the average coin was last moved at. When market price approaches these realized bands, long-term investors typically accumulate. Third, long-term holder supply. When the supply held for 155 days or longer is rising, the market is being supported by strong hands, not speculation. Fourth, stable coin supply ratio. A higher SSR means more stable coins on sidelines relative to Bitcoin market cap, indicating potential buying power. Fifth, miner revenue pressure. After a halving, miners often feel tighter margins, leading to a period of consolidation. When miners selling slows, supply dynamics strengthen. By watching these indicators, investors gain insight into what large players are doing, not just what retail noise suggests. Next, we're going to talk about why institutional adoption changes everything. Major financial institutions are now offering Bitcoin ETFs, institutional custody solutions, and tokenized asset platforms. Stablecoin settlement infrastructures as well. What does this mean? It means digital assets are no longer fringe. They are now embedded in global financial architecture. Institutions do not react emotionally. They accumulate during periods of consolidation and position themselves before major market expansions. Their behavior is a leading indicator, and right now their activity is signaling long-term confidence. Next, we're going to go over altcoins worth watching. Bitcoin is the anchor of the digital asset ecosystem, but strategic exposure to high utility altcoins can enhance returns. Here are categories to watch, not specific recommendations, but sectors with strong fundamentals. First, layers. You got networks. These blockchains compete on scalability, programmability, and transaction efficiency. Strong developer activity is key. The second layer is scaling and solutions. These platforms reduce congestion, improve transaction speeds, and support broader adoption. They benefit directly from underlying layer 1 growth. Third, we got real-world asset tokenization. Tokenized treasury bills, real estate, or cash equivalents represent one of the fastest growing segments. Institutions are actively entering this space. Fourth, DeFi infrastructure. Protocols that enable lending, staking, liquidity, provisioning, and yield generation are evolving rapidly. Fifth, AI integrated crypto projects. Projects merging blockchain with machine learning and data markets are gaining momentum. Diversification across these segments can create exposure to future growth while managing risk. Next, let's talk about how to buy crypto responsibly. This is where many investors make mistakes. They approach crypto emotionally instead of strategically. Here's a responsible framework. First, use dollar cost averaging. Allocating a fixed amount consistently reduces volatility, risk, and removes emotional decision making. Second, cap your risk exposure. Most investors should remain between the 1 to 10% of their portfolio in digital assets until they get comfortable and are more experienced. It all depends on your personality and risk tolerance and long-term goals. Someone younger is probably going to be more aggressive than someone older. Third, prioritize security. Use reputable exchanges, enable 2FA, and transfer long-term holdings to cold storage. You can get a Coinbase referral link in the comments below and get $15 worth of cryptocurrency to learn and earn. So be sure to check that out after you get through watching the rest of this video. Last, we're going to talk about avoid leverage. Excessive leverage is the primary reason investors lose money in crypto. It magnifies volatility and leads to liquidations. Next, we're going to talk about macro trends supporting crypto growth. Beyond crypto-specific catalysts, global macro conditions are supporting digital asset adoption. You gotta also keep keep in mind that there's rising government debt. High levels of debt encourage investors to diversify into non-correlated assets. Second, global liquidity cycles. As centralized banks shift policies, liquidity and cash flows into risk assets, including crypto. Third, digital payment growth. Younger generations prefer digital-first financial systems. Crypto benefits from this demographic shift. Fourth, dollar dominance and stablecoins. Dollar-backed stablecoins are expanding globally and demonstrate real-world utility far beyond speculation. These structural forces underpin long-term value creation. Next, I'm going to talk about the biggest risk to you that you must manage. A strong opportunity does not eliminate risk. Here are the key risks you must manage: regulatory uncertainty, exchange security breaches, smart contract vulnerabilities, and market manipulation during low liquidity periods. And finally, high concentration among whales. The goal is not to avoid risk entirely, it's to manage it with discipline. You got to understand your own risk tolerance. Everyone's different. I appreciate everyone watching the video this week. Please hit the like and subscribe for more investment videos. And we'll have another video posted next week. Hope everyone has a very profitable week. Follow for more.